So on Friday, PM Anwar announced the largest ever pay hike for civil servants, 7 to 15%, with the higher range received by implementers as well as professionals. Meanwhile, the 7% is received by those in the top management. Now, apart from being the largest ever pay hike, Anwar also took this opportunity to raise the minimum salary of civil servants to 2,000 ringgit, previously from 1,765 ringgit. And fun fact, I would say not so fun fact, the last time civil servants, their salaries were revised was 12 years ago. So you can imagine their starting salary stayed at 1,765 ringgit for 12 years. Okay, so it's about time. And what's really mind-blowing about this increase is that it is performance-based. Anwar said that those who are slow, lazy, negligent, they will not be guaranteed raises, even if they have been in the civil service for 20 years. Meanwhile, those who perform well will receive raises, even if they have been in the civil service for less than 10 years. It will be implemented in two phases. Phase one will begin in December, so implementers as well as professionals will immediately see an 8% pay increase. Meanwhile, those in the top management will receive a 4% pay hike. And the next phase, which will occur on 1st January 2026, 7% for implementers as well as professionals, and the remaining 3% goes to the top management. So you can see that the percentages add up to what I presented just now. Yeah, but what was announced is significantly different than what was presented on Friday. I'll give you an example. A grade U29 nurse whose current salary is about 2,457 ringgit, by December, they will see an almost 10% increment to 2,700 ringgit. Meanwhile, just 2 years later, in January 2026, phase two, they will see another 11% increment, which brings their salary to almost 3,000 ringgit. So if you add these two figures up, right, it's over a 20% increment. But that's because this table over here, this calculation, includes allowances as well as further salary adjustments. And therefore, the true increase in income could range from 17 to as high as 43%. Now, I'm all for it. I entirely support this move by the government because we all know that some of the civil servants right now are severely underpaid. You take a look at teachers, firefighters, doctors, nurses. Yeah, the list goes on and on. There are so many of them. The population is 1.6 million. So the government has allocated 10 billion ringgit for this announcement to be distributed gradually over the next few years. Well, a lot of people are supporting this move, but some people are saying that, hey, what about inflation? Right? If you are injecting so much money into the economy, this will most certainly drive prices up, right? Well, I don't think so. Okay, because like what I said just now, this 10 billion ringgit will be distributed gradually. Phase one, phase two, even after phase two, there will still be quite a lot of money left over, which will be distributed over the next few years. And we also have no idea where citizens will spend. Some of them might use the extra money to invest. Some may use it to pay off their debts, which in this case destroys money in the ecosystem, promoting disinflation, which will hopefully offset the impacts of inflation. Okay, so it's a bit too early to say that this 10 billion ringgit will drive up prices. I'll give you another example. EPF account 3, it was launched in May, right? So far, about 8 billion ringgit was withdrawn. But there is little to no impact on inflation. Malaysia's inflation rate May came in at 2%. Last month, June came in at 2%. It is well within Bank Negara Malaysia's target of about 2 to 3%. So another more important question is, where is this money coming from? Is it going to come from taxpayers or not? Well, it's already sort of coming from taxpayers already, because remember earlier during the year, this 2% SST increase, well, it is expected to net the government an additional 3 billion ringgit. And back in June, the government has also removed diesel subsidies, which was initially criticized by many people, including myself. I think that the government should have delayed this increase, not put it together with the SST increase, right? But props to them, they have managed to implement these two reformations and kept inflation pretty steady. Also, credit goes to Bank Negara Malaysia. And because of this, diesel subsidy removal, it will save the government about 4 billion ringgit every year. This gives them a lot of extra money to spend on things that truly matter. And this is a really good start, which is giving civil servants the pay hike that they deserve. So, wave of other good news. This one I've talked about many times. Yeah, positive numbers in our trade and GDP. JP Morgan upgrading our rating. Country emerging as a hotspot for semiconductor firms. Plus, we are scheduled to be the largest data center market by 2035 because we have the land, we have the space, energy, water. Our land is significantly cheaper compared to Singapore. Yeah, we have all of these good factors coming in, which is why in the past month you see the ringgit surge all the way from 4.70 to a 1 year high of 4.43. And if we continue on this trajectory, I wouldn't be surprised if we can end the year at 4.20 against the US dollar. Hopefully, keep our fingers crossed, next year the ringgit will touch the 4.0 mark against USD. And that will most certainly put us as a high income nation. But we have a bigger problem. We have to address the elephant in the room also, which is our national debt. 31 billion in 1978. It has ballooned 35-fold, or 3,548% to 1.1 trillion. And for those of you guys who are wondering, how does the government get into debt? Well, they mainly get into debt by issuing government bonds, which is a security in order to support their spending and obligations. Yeah, let's say they don't want to increase the taxes. Yeah, another way to generate revenue and to get some money from citizens as well as investors is to issue government bonds. And all of this will contribute to the national debt. In fact, in the past 13 years, our debt servicing load has tripled. From 2010, started at 15.6 billion to 2023, 46.1 billion. So debt service charges is basically the cost that the government needs to pay every year in order to repay back the debt's capital plus interest. And more recently, it's starting to occupy more and more of the government's revenue. In 2010, it's 10.3%. Right now, it's almost 16%. Or you can think of it this way, 16 cents that of every ringgit we pay in taxes will go towards repaying the national debt. So it's quite worrying. For budget 2024, the Education Ministry, they've received the largest allocation at almost 60 billion ringgit. And meanwhile, the Health Ministry is the second largest. They were granted 41.2 billion ringgit. Now, our debt servicing load has already surpassed the spending for healthcare. And previously, our debt to GDP ratio held steady at around 50 to 55%, averaging 52.5%, right, from 2014 to 2020. But COVID exacerbated government spending, which spiked the ratio all the way to the current figure of almost 65%. You can also think of it this way. It can also be interpreted as the number of years that Malaysia will take in order to repay the national debt using GDP. So with this ratio over here, right, about 65%, it will take us 65 years to repay our national debt. Now, a high debt to GDP ratio is necessarily a bad thing. If you take a look at Singapore, right, their debt to GDP ratio is almost 200%. But their credit rating is still AAA. Well, that's because the country borrows money to invest in other countries, not to spend. They remain as a net creditor nation. So this is some of the things that Malaysia can learn from. Otherwise, this national debt piles up, it will definitely affect all of us, especially your kids. Okay, so government, at the end of the day, will have to spend more and more to repay these debts and less on things that truly matter, i.e. education, finance, infrastructure, healthcare. All of this will gradually be squeezed and the government has to pay more and more towards servicing the debt. Okay? More taxes, borrow more, right? So the problems will be compounded onto the next generation. But otherwise, so far, I think honestly, as a country itself, this year, a lot of good news has come back into Malaysia. And hopefully, yeah, keep our fingers crossed. Make sure this good news continues. Make sure the current administration continues doing what they're doing. And we may really see the ringgit hit 4.0 by 2025. What do you think is the best method to allocate our money and make full use of it? Example, I budget my monthly allowance, pay out all my commitments, and set aside money for buying stocks in Mumu's money market fund or maybe low risk investments like ASB. The remaining money is for food, etc., surviving the month, and I put it in Touch and Go Plus. And whenever I want to make a purchase, I transfer it to GX Bank. Doing this gives me the daily returns from Touch and Go and cashback from GX. Any other better option that I'm missing out on? Okay, so I would say it's a good start, lah, okay. But if you really want to budget your finance accordingly, one of the most simplest methods that I'm currently using is the 50-30-20 rule. It's a very simple rule. You allocate 50% of your monthly pay towards your needs. It goes to housing, groceries, rent, transportation, bills, utilities, health insurance, as well as your car payments. Basically, everything that you need to put a roof on top of your head. Right? Then 30% goes to wants. This one is anything that you want in the world. You want to travel, you want to go for movies, you want to go for fine dining, all of it goes here. And the remaining 20%, think of this amount as your future. Right? First, you build your emergency fund first. You want to make sure you have at least 6 to 12 months worth of your monthly expenses, which means if you use about 2 to 3,000 ringgit every month in order to pay for your needs, then your emergency fund should at least be about 12,000 to 16,000 ringgit. Okay, then only after that you go towards your retirement planning as well as investing. So I'm looking at this currently, you have your budgeting already, right? But maybe you might not be investing aggressively enough. Right? Because if you are young, you are still 20 to 30 years away from retirement, your main priority should be investing aggressively in order to maximize your returns. If you are still putting the majority of your portfolio in very safe assets such as ASB, fixed deposits, EPF, right? Then in 20 to 30 years, the returns good is steady, yeah, 4 to 5%, but it's nothing compared to someone who's investing 7 to 8%. It makes a lot of difference. Okay. So now regarding this, you transfer your money from Touch and Go Plus and then you transfer it to GX Bank, you use that 1% cashback, sure, no problem. All of this will definitely make a difference in your financial well-being. Like I've compiled this list over here, right? Regarding where is the best place to grow your money right now compared to Rise, Aeon Bank, GX Bank, right? 3% versus 3.88%. Sure, you can move your money every month or every time you want to spend to these places. But if you find it a hassle, then I would say don't do it. Your priority should be focusing on increasing your income first because that's the bigger fish to fry. That's the one that will make a lot of difference. And investing right. So within your 50-30-20, right, assuming that you're using this rule, right, your main priority should be figuring out how can I increase my income? And next, with the remaining 20%, right, how do I invest right? Rather than, oh, how do I maximize, how do I squeeze out this additional 0.5 to 1% profit? Yeah, sure, this 0.5, 1% will make a slight difference for your financial well-being. But the bigger fish to fry, the thing that will make a lot of difference over here is investing right, as well as increasing your income. Why is the US lowering interest rates at the moment? Would it be possible if they increase it back and the Malaysian ringgit stays stronger at that time? Okay, well, the US is reducing interest rates. Well, they haven't reduced yet. They say that they're going to as early as September. And the biggest reason for it is declining inflation. Sorry. The biggest reason for it is declining inflation. If you track back their data, right, back in June 2022, their inflation reached a 4-decade high of 9.1%. In order to curb inflation, the Federal Reserve raised interest rates aggressively. And right now, because rates are at a multi-decade high, it's starting to hamper the United States growth. It's starting to prevent growth, okay? And if you take a look at US inflation, right, it has come down to the Federal Reserve's target range already. Yeah, the target range is about 2 to 3%. So if inflation continues to stay steady at this range, right, the US will start reducing interest rates, which they will be doing as soon as September. Okay, so that's the first answer to your question. And would it be possible if they increase it back? It is possible, but very unlikely. Because, like what I said just now, inflation has trend lower for quite a period of time already. And for them to raise interest rates back up, or for them to keep interest rates higher for longer, inflation has to spike back up again. Let's say over the next few months, spike back up to 4, 5, or even 6%. Maybe due to the geopolitical tensions in the Middle East, or maybe even due to, I don't know, maybe the COVID pandemic starts flaring up again, right? So it's very hard to say. But personally, I think it's unlikely that they will increase interest rates back up. And if the US were to increase interest rates, the Malaysian ringgit will definitely make a U-turn. Okay, so one of the largest reasons on why the ringgit is so strong at the moment is because of the US dollar's weakness. I'll show you guys another chart. Another chart is the DXY chart. So DXY is basically the dollar index. Yeah, compares the US dollar's strength against a basket of six major currencies, yeah, such as the euro, Japanese yen, British pound, so on and so forth. And you can see in the recent months how it has trend lower, right? And that has definitely contributed a lot to the ringgit strength, apart from the wave of the good news that I've talked about earlier during the session, right? Okay, so if the Federal Reserve were to keep rates higher for longer, if they were to U-turn and say we're going to increase interest rates again, yeah, that would definitely be detrimental for the ringgit. Not only the ringgit, in fact, all the currencies around the world. Looking at the USD MYR pair on TradingView, it seems to have a pattern where ringgit hits a support line currently. This has been happening for years, where the ringgit gets stronger and then weaker against USD. How can we be sure or confident that it is different this time? Okay. Well, in the past few years, if you take a look at 2022, right, sure, the ringgit has strengthened significantly, right? Let's go to the USD MYR chart, okay? If we look at 2022, this part over here, ringgit has strengthened from such a short span of time in less than 3 to 4 months. It has strengthened 10 to 12% to the 4.2 range, right? And coincidentally, this was when Anwar was elected, which led a lot of Pakatan Harapan supporters to believe that the entire reason for the ringgit appreciating to the 4.2 mark is because of Anwar's election. Well, that's not entirely true. There are a lot of factors at play here. But evidence is clear that we have seen this sort of movement before. And I think that this time it may be different because back then we didn't have so much good news, right? We didn't have investors coming back. Our country's rating was in fact still underweight. Underweight being negative, meaning that investors are not really positive or optimistic about our country's outlook. But more in the recent 2 years itself, right? You have big companies, Nvidia, Google, Microsoft, the list goes on and on. They've all set AI or data center markets in our country, or they are going to. Yeah, in fact, YTL, this company, right? Why they have surged so much this year since the start of the year, right? It's because they've secured a multi-billion-dollar deal with Nvidia, or is it TikTok? Either one of those companies, okay, to set up AI center and semiconductor hubs in Johor and in the entirety of Malaysia. Okay, so yes, I believe this time is different. Plus, this time we also have started to do a lot of big reformations. Yeah, the first biggest one is the removal of diesel subsidies, which will really steer us into the right direction. Will really give the government much more additional money to spend. Plus, probably in the next 1 or 2 years, we are going to see petrol subsidies to be gradually lifted also. So all of these things, right, is what we need in order to drive the country forward. And one of the first indicators that we are seeing is ringgit strength. Okay, so it may still be too early to say regarding this. Okay, I may entirely be wrong, but hopefully I'm right. Okay, I keep our fingers crossed and hope that by 2025, maybe 2026, we may see the ringgit hitting the 4.0 mark. Okay, barring any unforeseen events. Okay, so hopefully I answer your question. Second, this question, if US Fed cuts interest rates, we know USD depreciates, but how will a rate cut affect the stock market sentiments in general? Okay, so rate cuts, right? You have to think about what interest rates mean. Interest rates control the borrowing costs, right? If interest rates are high, your borrowing cost gets more expensive. Therefore, you are less encouraged to spend. You don't take out more loans, then you'll be a bit more conservative. You save more, right? Because now your FD rates are higher. Conversely, it's true, right? If rates are low, rates start to get cut, then people will be more inclined to spend on the economy. People will take money out from their fixed deposits because fixed deposits not giving that juicy of a yield anymore, and they'll start investing it where? Into the stock market, like that's the first thing. So that's why if you take a look at the US stock market, right, the S&P 500 index, the entire reason onto why we are seeing the US stock market rallying by so much since the start of the year, almost 17%, right? It's because of speculations over at the US, they are going to cut interest rates, right? And if it's true, if the Federal Reserve in September says that, oh, okay, right now we're going to slash interest rates by 0.25%, we think inflation is pretty steady, right? We are going to continue doing so until so and so, right? That will definitely lift the markets. Shout out to all our patron members, yeah, gather members: Andrew, Wendy, Edward, Alex, CC, Is, Urshad, Caveman, Kelvin, Tommy, Jinkang, Adrian, JS, Wenyan, Dean, Duhan, Sufi, Faris, Alan, Jackson, Raizan, Hudson, G, Jeffrey, Lawrence, Lukman, Will, Jack, YC, Arif, Hazik, Jinden, Adam, Adrian, Ashley, Sean, and Jason, as well as all of our learner members. Thank you guys so much for joining. Stay safe. Good night, everyone. Bye.